Welcome everyone to the Verdi Wealth Management podcast. My name is John Gottschall and I'm here with my partner Mark Miller. Today we're here to talk to you about finding value in today's market. Welcome, Mark.
Good morning, John.
How's it going?
Not too bad. Beautiful weather we're having right now.
Oh, I love it. 70 degrees or so. Puts everyone in a really good mood. I noticed you're having your traditional venti vanilla non-fat latte, which is Italian for $7.
It is expensive, but I love my Starbucks coffee.
Yeah, me too. It's always fun to go there and kind of hang out and catch up on your reading. Which leads me to a question. Mark, who's one of your favorite authors?
John, that's a good question. A question I get asked quite often. I actually prefer nonfiction, and I do have a lot of nonfiction authors I like. But if I would actually have one favorite nonfiction author, I'd probably have to say Michael Lewis.
Yeah, he's good.
He's written several books I like: Liar's Poker, The Big Short, Flash Boys. But I'd have to say my favorite book by Michael Lewis is probably Moneyball. He wrote back in 2003.
Yeah, good one. Good movie, too. Tell me, Mark, why do you like Moneyball over the others?
I think the reason why I like Moneyball so much is because there's a lot of similarities and parallels to investing.
I totally agree with you. For our listeners who don't really know the story of the book Moneyball, which became a movie as well, it's really the story of Billy Beane, who is the general manager of the Oakland A's. In the early 2000s, Oakland was struggling to keep up with the bigger market teams like New York and Boston for no other reason than just they didn't have the resources that those teams had. So Billy Beane came up with creative ways to find what they considered undervalued players. And instead of looking for things like batting average and RBIs and hits, they would look for people who walked a lot, even if their batting average was bad. And so the book gives the story of just how they searched for value in the baseball market and built a really competitive team. And I think, like you're saying, that's something we try to do as investors as well. So to segue into the market, where are we looking for value right now?
It's a tough environment right now, John. We've got very little volatility in the last couple of years, and volatility is starting to raise its ugly head. We're coming off an incredible year in regards to the stock market returns, not just here in the U.S., but across the globe. One of the biggest questions in my mind is just how late are we in this economic expansion and bull market cycle? The current economic expansion really began in June of 2009, almost 9 years ago.
Yeah, and I think if it continues on through 2019, it'll be the longest in recorded history. I guess, like you said, the million-dollar question is, when is this boom going to come to an end? Meaning, when are we going to see our next recession?
That's also a good question. I've been through many recessions in my career, John, and I can tell you that they do not start when the economy is weak, but rather when good news and growth have reached a peak. Certainly not going to sit here and tell our listeners when the next recession is going to happen, because truthfully, you don't quite know when you're in a recession until you're actually in it.
Yeah, well said. We can never exactly predict these things, but one thing of note is the 10-year Treasury recently hit 3%. This is something we haven't seen in, I think, over 4 years. It kind of caused a little mini panic in the market. Why is a 3% number in the 10-year government bond significant?
Well, we haven't seen 3% on the 10-year in almost 4 years. It is a significant number. Why is it 3%? I'm not sure. Several factors come into play in regards to rising rates, John, and I won't take you a deep dive and a ton of time going through all of them, but simply stated, a sustained rise in yield cuts against the narrative of historically low interest rates used to basically justify equity valuations. A rise in yields also has implications for debt servicing costs for corporations that need to access debt or bond market. Will have higher costs when borrowing, which could ultimately affect their margins and earnings going forward.
You're totally right. I think it was a couple years ago. I think Apple was the poster child for this. They took out debt in the form of a bond issue in order to help pay their dividend, because they could access debt for so cheap. And not every corporation can do that, but it does speak to the story of low interest rates can provide really good tailwinds for corporations. Mortgage rates also loosely follow the 10-year note. And as a lot of us know, the lower your housing payment, the more money you have to spend on everything else. So as rates move up, it's going to push some people out of the housing market or give them less money every month to spend on other things. So that could be a headwind with rising rates, although historically 3% is still low on the 10-year government bond. But on the flip side, the bulls would say and argue that 3% in the 10-year is a good thing because the economy is finally strong enough to warrant higher borrowing costs. And there's still several reasons to continue to be optimistic. Extremely low unemployment, decent GDP growth, corporate tax reform, and several other factors. But let's get back to our original question. Just like Billy Beane was searching for value and looking for obscure outfielders in the minor leagues and in college, where are we searching for value right now? Let's start with the U.S. markets.
I like small and mid-cap stocks, John. They grossly underperformed large cap last year. One of the main reasons I like small and mid-cap are because of corporate tax reform. Most of the revenues come domestically in the United States, and they're going to be big benefactors of tax reform. And tariffs right now are headline news, and a lot of it's noise. I don't know if it's more bark than bite, but if tariffs do come into fruition, the bigger, larger companies in America, the multinationals where revenues are derived overseas, the mid and small cap won't have to deal with that. So I do like mid and small right now.
I agree. What about outside of the U.S.? What regions of the world are looking relatively attractive right now?
I like the European region, John. Although their market is not as cheap as they were a year ago, I still think they're cheaper than the United States. They're trading at 13.5 times earnings versus the U.S. is 16.5 times earnings.
And let me just interject for a second for our listeners. When he says 13.5 times earnings, that's the PE ratio on their market as a whole. PE is price divided by earnings. So basically, how many dollars would you pay for every $1 of earnings? So like he said, in Europe, right now we're paying roughly $13.5 for every $1 of earnings that their market has. And in the U.S., $16.5 for every $1 of earnings. Sorry to interrupt there, Mark. But
No. Not just purely based on valuations. They also have an improving economic growth, better corporate earnings, and the European central banks are continuing to pump stimulus into their economy, which should help continue to keep interest rates low, unlike here in the United States. European companies are expected to see 9% earnings growth and roughly 4% revenue growth through 2018. They are also benefiting from lower labor costs, lower interest rates, which helps refinancing costs and lower basic material inputs.
That makes a lot of sense. As I sit here and look at my iPhone, it reminds me that we also search for value by sector. We all know tech stocks had an incredible run last year, led by the FANGs, which is an acronym for Facebook, Amazon, Apple, Netflix, and Google, companies we use every day. But they've been getting kind of beat up lately, and a question we've been getting a lot is, are these companies overvalued? I think what's happening right now in the tech sector is a lot of these stocks are kind of priced for perfection. Earnings are still coming in strong. We're just seeing a lot more volatility in the growth and tech sector specifically. And I think that's due to a number of reasons, and you can kind of expand on this, but rising interest rates. These companies, like we touched on before, they've been able to borrow at really cheap costs for a long time now. And if their borrowing costs go up, just like if our mortgage payment went up, it's going to hurt their margins, and their earnings won't be as robust as they have been. Part of it, too, is just a lot of headline risk. We saw Zuckerberg having to go before Congress. Facebook's been kind of getting in trouble in the news lately, and I still think it's relatively, that whole sector, the internet and what they're capable of, artificial intelligence, it's like that whole sector is still probably in its infancy. When we first invented the car, Henry Ford or whoever invented the car, they didn't have seatbelts, but they figured out after a while people go flying out of the car. they put seatbelts on the car. So I think that sector as a whole will get it figured out. Earnings are still strong, and I think we're still bullish on a lot of these companies and on the sector as a whole, long term.
Yeah, I would agree. Not only Facebook, but Amazon and Donald Trump finding out. I think Donald Trump just is not happy that Amazon doesn't pay any taxes. And so that's been headline risk as well for Amazon.
Right, even though Donald Trump ran on the premise that he was proud that he didn't pay any taxes because he was smart enough not to.
Exactly. John, you talked about the FANG stocks and more growth-oriented equities. I'm going to segue into the value stocks, and the sector I like the most in the value area is financials. Banks' balance sheets are healthier now since pre-Lehman Brothers, and they've been doing well even with a very flat yield curve. And as the yield curve starts to steepen, they're going to be a big benefactor of what I would call net interest margins. That's just them being able to borrow at a lower cost and loaning that out at a higher cost, which will ultimately lead to better earnings going forward.
Yeah, that makes a lot of sense. And just to add on top of that, we have a current administration that would be pro-deregulation of the financial sector in general, which should benefit them. And of all the sectors, they paid, if not the highest, one of the highest effective federal tax rates. So again, corporate tax reform should help financial stocks a lot.
Yeah, that's a good point, John. That's exactly right.
Well, I think that wraps things up for today. Thanks, Mark, for all the informative input you gave us.
You're welcome, pal.
Just like Billy Beane in Moneyball, who was searching far and wide for value in regards to baseball players, we too are in constant search for value in regards to investments, whether by region, sector, or style. I want to give a special thanks to David Andrews for letting us use his music for our podcast. And until next time, enjoy your day and have a great weekend.
Photograph hanging on my wall in my room. I'll be taking it down for a while. So it's closer to me, I'm closer to